Hey, good morning. This is Chris with Suarez Home and Finance. We are on Coffee with Chris. So we're going to talk today about loan types and requirements. So there is a lot of what loan type is best for me. There's a lot of people that I run across that don't know what loan type that they have, or they're not sure if something is better for them. There's a lot of I've seen a lot of people that are put into an FHA loan instead of maybe a conventional loan or a VA loan or something that is better suited for them. So it is very important to know what you qualify for, what is out there, and what the requirements are. Sometimes it's better to do one loan type to get started versus another one due to maybe the interest rate or your debt ratio or your credit scores. So there's lots of variables. um, we talked about before interest rates and the loan types. People will say, okay, well, what is going to be my interest rate, today? Well, it's not something that you can just do right off the cuff because there's so many different variables in it. And the loan types is a very big variable. Your credit score dictates your loan type as well. What is your criteria? Just all of the different ins and outs as far as that's concerned. So we're going to talk about the loan types and um, the ins and outs looks like. So the first loan type, so that's what we're going to go through today. I'm sorry. We're going to go through. So a VA loan is the I feel is the best loan if you qualify for it. So VA is military backed. So or it's if you've been or are in the military at some point, that is the best loan that there is. It is 0% down, so on and so forth. We're going to go through that in just a minute. Conventional is, in my opinion, and all of these are I'm not an attorney. I'm not a real estate agent. I am not FHA. I am not VA. I'm none of that. This is my um, take on things. This is my educating you, all of the above, but I am very good at guidelines and I do go by the guidelines themselves directly. So your finance person that you may be using, they may have overlays. So a lot of times the banks do have overlays. So what I'm going through you is going through with you is based on the loan type itself. Again, if you're dealing with a bank, they may have a minimum credit score of a 720, of a 680, different things like that. What I'm going through is what the loan type requires. So if your bank requires a higher score than what you have, there's still the possibility of getting a loan. Absolutely. So don't stop there. So VA is the primary, in my opinion. Conventional is second. USDA is third. FHA is last. And then we have non-conforming. Those are kind of outside the box, more of self-employment, investor, things like that. If you've had some kind of a life event like a bankruptcy recently, foreclosure, different things like that. So that's what that is. So we'll touch a little bit on that, but that is going to be, again, a case by case and so on and so forth. So let's get right into it. So a VA loan, what is a VA loan? So a VA loan is 0% down, no mortgage insurance, meaning that you don't have you're not paying a monthly mortgage insurance because you're borrowing more than 80%. So for round numbers, if you're purchasing a house for $100,000, 20% down on a conventional, which again, we're going to go through, requires no mortgage insurance, but VA requires no mortgage insurance whatsoever, 0% down. It is government backed. And there's no minimum credit score required, but there is overlays, there is caveats. So there's no minimum credit score required. So we can do a no score, or VA allows a no score. And then you do have, it depends on your credit criteria. It depends on what's going on with your credit, what's going on with your whole scenario. is where it depends on what the minimum credit score is. I do have sometimes I have overlays on that. If you have a credit score of, let's say, 580 and you have recent late payments, you just had a bankruptcy, you just had a foreclosure, something like that, or whatever. If you have those things, then the likelihood is probably going to be that it's very difficult. There's somebody knocking at the door. I'm sorry. It's going to be very difficult for you to get a loan at the moment because you've got those recent late payments and things on there. So that is, again, a case by case basis. So just because VA requires no score or allows for a lower score, even if it's in the 500, 550, totally depends on what what is going on with you. Prime example, and this goes with a few of the different loan types that we're going to talk about, is I had a client years ago, and I think I probably talked about her, on these podcasts before as well. She had a 530 score, 530. That is low. But the reason why her credit score was low is because of only medical. She had great credit score, or great credit. She had different trade lines for several years. She made her payments on time, so on and so forth. But she was an epileptic. I think I'm saying that right. I'm probably not. So she, had to call the hospital all the time, or call an ambulance or whatever to come and get her. So in that instance, she had a lot of medical on her. She had a lot of medical collections on her credit. We were still able to do her loan because that was the only negative that was on her credit. So it is possible. It is a case by case. Seller concession. So VA allows for 0% down. I will have clients that will say, well, we bought it with a VA loan before and didn't put any money down. Right. It's because you had seller concession, meaning that somehow, some way, your agent did the numbers and rolled in and said, okay, we're going to offer you $100,000 for the house, but I need you to pay $5,000 of the seller's or of the buyer's closing costs and prepaids. So that is the only way that you can, with a VA loan and some of these other ones that we're going to go through, that you can come to the table with no money. So VA gives a cap of 4% in seller concession, but also allows the seller to pay discount points and other closing costs. So there's not per se a cap of the 4%. There is, but there's not. So we have gone up to 6% in seller concessions. But sometimes on a higher dollar amount, you don't need that much. So that's where your finance person and your realtor helps to work those numbers out. But again, that's the only way that you can come to the table with no money in that instance. And that doesn't mean that there's no upfront cost. In every loan, even if you have down payment assistance, there's always going to be upfront cost, which is, your escrow, your appraisal, your home inspections. All of those are upfront costs that you have to have money. So whenever we're saying 0% down, that means that the loan requires 0 down payment. You still have out-of-pocket costs regardless, no matter what. And that is a big misconception that a lot of people have. Well, I'm getting down payment assistance. Okay, great. You're getting down payment assistance, but the down payment assistance comes into place at closing. You still have upfront out-of-pocket costs that you have to have in order to buy a home. Period. It is what it is. You're buying an investment. You're buying your home, your dream home, whatever it is to you. There are out-of-pocket costs. So just because it says 0% down does not mean that you do not have one dime to put in it. So make sure that you're aware of that. And that's for any loan type. So your down payment required is for your down payment. You always have upfront cost out of pocket. So next is your debt ratio. So your debt ratio is your gross income before taxes taken out, divided by your expenses. And so, or your expenses divided by your income. So what that means is your expenses are your mortgage payment, your new mortgage payment, if you've got a current home, anything that's on your credit report. If you owe IRS money and you're making payments, that's included. If you have child support, payments that you're supposed to make, that's included. So that is a debt ratio. That's how we determine the debt ratio. with VA is very forgiving, and again, it is the best loan type, I believe. So it goes by a system that I have to run you through, and it's a model of where, this is the first step of underwriting. We do it for all clients. That's what our pre-approval is based on, but that's where you are talking to your finance person, because, and again, this is where some banks may have overlays. I've had VA approvals up to 80% debt ratio, which is crazy. But again, your bank may have an overlay of 45%, 50%. So VA directly doesn't have a guideline as far as that's concerned. It depends on this system that we run it through and get what's called automated findings, so on and so forth. So that is that part as far as debt ratio is concerned. Another big misconception is that I cannot have two VA loans. Yes, you can. So if you live in out of state, so I'm in Florida. If you live in Texas and you have a VA loan and life changes, you're moving to Florida, and you decide you want to keep that home and rent it out, and it's a VA loan, you can still have a new VA loan in Florida. We just have to do some calculations, and that's required by VA. If you meet those calculations, maybe you have to come to the table with no money. Sometimes if the calculation is a little bit off or whatever, you may have to come to the table with some money, but that has to be done up front. So again, there's different, things that have to be done. But yes, VA does allow for you to have more than one home. Again, that is a misconception that's out there, and it is allowed. So we're going to go to the next one. This is in my opinion, number 2. What is a conventional loan? So a conventional loan, minimum down payment is 3% if you're a first-time home buyer. So it goes anywhere from 3% up. Anything less than 20% down, you will have mortgage insurance. So mortgage insurance is, let's go back to VA for a minute. So VA is backed, and talking about the mortgage insurance, VA does not have it. The VA backs the loan. It's a government backed, meaning, and this is with any of these loans, where you have the different mortgage insurance and so on and so forth. So let's say, for instance, you bought a house and your loan amount was $300,000, and something happened, somebody got sick, whatever it is, you lost your job and you got foreclosed on. So the bank that is holding your current note has to sell the house for as much as possible. So your loan is for $300,000, they can only sell it for $280,000. So you have a deficiency of $20,000. So with VA, they are backing it 100%. That's why they're 0% down. They write a check to the bank for that $20,000 deficiency. So that's what that means. It's VA is backing it with 100% guarantee. So now we go to conventional. So if you put less than 20% down, you do have mortgage insurance. Same process goes. If you buy a house, you get foreclosed on, the mortgage insurance writes a check to the bank for that deficiency that's there. They can put a claim on you for that deficiency, just as an FYI. I've seen it, but then I've seen it not. So I've seen it, both ways. So mortgage insurance on conventional, anything less than 20%. And then, let me see, next is, then you have, it is not government backed. So it is not like VA that it's government backed. Okay. It is, Freddie Mac or Fannie Mae or Freddie Mac. The score requirements, and again, based on the loan type, your bank, your person, whoever may have an overlay, but the loan type requires a minimum of 620 score or a true no score, meaning all 3 of your bureaus kick back and there's no score at all. Again, your bank may require a 680, 700, whatever the case is. The loan type itself requires a 620. Again, caveats with that. So if your score is a 620 and you're putting 5% down, your mortgage insurance is going to be a good chunk. And sometimes that's where, okay, is it better to go FHA versus conventional? It depends on your scenario. It depends on what your goal is, how long are you going to be in the house, so on and so forth. So there's a lot of different questions back and forth on that. So then you have seller concession. So if you're putting less than 10% down, then the max seller concession is only 3%. If you're putting 10.01% or more, then you can get 6% in seller concession. We went through what that was just a minute ago. And so seller concession, again, is the seller paying your closing cost. So if you're putting 3% down, you could come to the table with 3% down. You have your escrow deposit that is applied towards your down payment as well. Again, you have those upfront costs, your appraisal, your inspection, so on and so forth, that are not part of your down payment. They can be allocated sometimes into your down payment, but it is an upfront dollar amount. And then the max debt ratio on a conventional. So the max is definitely 50%. You cannot go over that. I've seen it like 50 point something other percent. Again, it depends on your bank, your finance person. It also, in my realm, it depends on what that automated system comes back with, because your credit scenario, your whole scenario dictates that. But 50% is the general rule of thumb, that it won't go past that. In guidelines, they were passing, 43%, but we can still get it at up to 50% depending. So that is, again, a case by case. If you're buying an investment home, then normally it's 45%. So that is conventional. Next is a USDA loan. Again, this is my number 3 in pecking order as far as a loan type. So USDA is 0% down like VA. USDA is not government backed. It's actually a budget in Congress that they pass at the end of each, or at the beginning of each fiscal year, whatever, at the end of each fiscal year for the next year. And so a lot of people that think that it's government backed, and it's not. It's through Congress, and they approve the budget for those funds to be there. So you do have a monthly guarantee fee and an upfront. So if, again, use that $100,000, if you're buying a house for $100,000 and that is your base loan amount, because you're putting 0% down, then your loan would be for the $100,000 plus 1%. So it would be for 101. And that's because you're borrowing more than 80% and you're doing a USDA loan. Then there is a monthly guarantee amount of that as well. So, and that is for the life of the loan. And so right now, I think that's like a 0.35 or whatever. So that amount, I did some calculations. And so let's say, for instance, if your USDA monthly guarantee amount was $50 a month times $360 or 360 months in your loan term, then that's $18,000. You're paying $18,000 over the life of the loan. Number one, if you keep it for 30 years. Number two, because you did not have 20% down. But again, is it worth that? Yes, it is in a lot of cases. You can always refinance out of a USDA loan into a conventional later, but you got into the house with 0% down. You were able to get into your home, so on and so forth. So it's still, a benefit. 6% seller concession is the amount that's allowed. The debt ratio is, I don't think I put the credit scores in there. The minimum, or yes, I did. There's no minimum credit scores, but again, there are overlays, and it depends on what the system comes into. So we can do no score, or USDA allows for no score, but also, again, if you're in those 500s, it's going to be a lot tougher, if even possible, if you've got negative stuff on there. So if your scores are in the 500s, and you've got recent late payments, then the likelihood of you getting a loan right now is probably not going to be. Very, very slim chance. If you have medical and that's all that it is, like what we just talked about, then that's more of a possibility. So max debt ratio. Max debt ratio is about 47% that I've seen. That's with good credit scores, higher credit scores, no payment shock, meaning you're used to paying $1,000 for rent and your mortgage payment is $1,000 or cheaper. So there's different caveats that help to allow that. Normally, it's going to be in the lower 40s. But I have seen it about 47. Again, your bank may have an overlay. I'm going with the loan type guidelines and from what I have seen. So that is a USDA loan. FHA. So FHA is the last in my pecking order, in my opinion, because you have the mortgage insurance for the life of the loan. So let's start from the top. 3.5% down is required. You can absolutely put more money down. Some people have to go FHA because their scores may be higher, but they have limited funds. Their scores may be lower, and so that's the only option that they have. So it just, is a case by case. So your scores may be lower, but you can put 10% down, but because of your scores, FHA may be the only option. So again, in my opinion, FHA is the last option that you want to look at. I do them all the time, every day. So it is something that you do have to do. And to me, it's a short-term loan, because your goal is to get refinanced out of that as quick as possible. So you do have the monthly mortgage insurance and an upfront mortgage insurance premium. So the monthly mortgage insurance is for the life of the loan. Unless you're putting 10% down, then that period shortens. So the calculation, for instance, on an FHA loan is that, let's say, for instance, if your monthly mortgage insurance is $150 a month times 360 months, okay, so that number is $54,000 over the life of the loan if you keep it for 30 years. That is why, in my opinion, you need to refinance as soon as you can. General rule of thumb is that you make 6 payments and then you refinance after that, if possible. It also depends on, do you have, has the value increased? Again, variables. So this is where your finance person, looking at everything to see what makes sense for you. On the same token is that if we do an FHA loan, if you have to do that, then you really need to, did you have to do it because of your credit scores? You really need to work on your credit scores in order to get out of that FHA into a conventional to be much better. That's if you don't qualify for a VA loan. So again, in my opinion, FHA is a short term. You need to work on things, whatever the case is. If you're waiting on a time frame because you had a foreclosure, you have to wait on the time frame to get into a conventional, whatever the case is. That's where my thought process goes. You can have, so FHA allows a 500 down to a 500. That's normally, again, not going to happen. That scenario that I just said about a 530 score, but it was, again, medical only. If you've got repossession, collections, everything else, that's most of the time, 99.9% of the time that I have seen, it's not going to happen. So again, total, variables and everything else. And we can do, the FHA does allow for no credit score at all as well. If you do have a no credit score, then you really have to have what's called non-traditional trade lines also. Have you paid rent on time for 12 months and can we prove it? Have you paid electric on time for 12 months and you have that, you have that history? We've used childcare. We've actually used karate. Grandparents were paying for karate. I think I've said that on a past class before, talking about credit. So different things like that is what we'll probably have to go whenever you're doing no scores. Seller concession. So you can go up to 6% seller concession. Again, the seller paying your closing cost. A lot of times that's included in the purchase price. So if you're wanting to offer 100, then you may be offering 106. With the seller paying $6,000 in your closing cost. Again, that's where your finance person and your real estate agent help you with that. FHA is government backed. It is a government loan. And so you're putting 3.5% down. So the government's backing at 96.5%. So again, if you get foreclosed on, they're going to, you've already put your 3.5% down. If you get foreclosed on, that deficiency, that's where HUD writes the bank a check for that deficiency. Again, they can put a claim on it, and you may not be able to get another FHA loan until that claim is gone. Somebody had mentioned recently, can you have a past FHA loan and can you have a new one? Are you only limited to one? No, you can have as many as whether you paid it, refinanced, sold the house, whatever it is, you can get a new FHA loan. The only way that you can have 2 FHA loans at the same time is if the homes are 100 miles away from each other. There's guidelines on that specific. So you can have two FHA loans, but again, you've got to be 100 miles separate from each other. But if you had an FHA loan in the past, you can have a new one. And then the debt ratio on FHA. This is again where sometimes FHA is going to be your only option for the time being. So if your debt ratio is 53%, no other loan allows for that unless you again, if you don't qualify for VA, conventional and USDA does not allow for that. So that's where you may have to go FHA because your debt ratio at the time is higher, meaning again, your debt versus your income is higher. So that's where that comes into play. And again, your bank, your credit union, whatever, they may have overlays on that. This is the guidelines, and this is how the actual loan type itself works. So non-conforming. Non-conforming means, in the best way for me to describe it is outside of the box. So you have VA, USDA, conventional, and FHA in a box. Those are the main 4 loan types. So anything outside of that is going to be outside of the box. And so that's going to be your bank statement loan programs, your asset depletion. You've got assets, and do you have 3 years of it there, so on and so forth, stated loans, different things like that. That's what's called non-conforming. If you're buying an investment property, different things like that. So that is outside of the box. And so that is going to be, again, case by case. What does your bank allow? All of those different things. So what loan type is best for you? So hopefully this gave you some information, told you, different loan types and everything else, and what would benefit you the most. So educate yourself. Make sure you know what's best for you and not just for your finance person, and what's easier for your finance person. Years ago, a lot of people had a very big stereotype on USDA that, oh my gosh, they're so hard. No, they're not. All loan types, in my eyes, are basically the same as far as what you need and what you have to do. They just have their different guidelines, credit scores, debt ratio, things like that. So in my opinion, there's not one that's going to be harder than the other. The property and your scenario is what makes it harder. If you're doing a manufacturer that's got, that's older, that's got issues and so on and so forth, that's going to be harder, especially whenever you're talking about a $50,000 manufactured home, that's going to be harder. A VA loan is not hard. There's so many vets that are nationwide not having their offers approved or accepted by sellers. It seems like it's changing a little bit now. But there's so many vets that are not getting their offers accepted because it is a VA loan. It's a stereotype. The VA loans are not hard to do. The biggest problem that I have with a VA loan is the appraiser. The appraisals, I've had several that have just recently, like in the last year, that we've had new construction that we've had issues on the appraisal. It's not the loan type, it's not the client, it's none of the above. So again, case by case. But all loan types are basically, in my eyes, the same. It just depends on what category you fit into. So make sure you know what category you fit into. Make sure that you are getting the best loan type for you. Make sure that you are educating yourself and saying, hey, well, why are you putting me in an FHA loan instead of a conventional loan or a USDA loan or whatever the case is? Ask the questions. Make sure that this is your money, this is your life, this is your biggest investment that you're going to make. So that is that's what I got for you today. So I hope you learned something today. We're going to kind of break this video up as well and put it into different, this is VA, this is FHA, blah, 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 so that, just more information out there. But so hopefully you got some more smarts in your brain today, and it's Monday morning, so get to it. I hope you have a great day. And I've got my list that I am on, so I will talk to you next week. We're going to have an expert on next week that I'm talking to today and getting everything finalized. So watch for us to share who that's going to be and what it's going to be about on Wednesday. So again, Monday morning, Coffee with Chris. Hope you have a great day. Let me know if I can answer any questions for you, even if I'm not doing the loan. I don't care. I'll help to educate you, tell you the whys. So talk to you soon. See you next week. Bye.